I didn't even have a passport.
Mm-hmm.
I applied for my passport after I got the job. And then they sent me the visa, and I showed up in Dubai, which was just a strip of sand at that time. And it was the first time I was away from home.
Wow.
And life has been good. Life has
Mm-hmm.
been good. I've always considered money to be an enabler.
Mm-hmm.
When I was growing up, it enabled my father to give me an education.
Right.
When I started earning money, it enabled me to replenish my father's coffers so that they had a trouble-free retirement. And once all that was done, it enabled me to, go out and meet people, in the sense I started traveling. It was time to spend money on myself. So it was all various experiences that I was seeking out. I traveled Europe, right from Greece down south to Sweden up north on Eurail, 5 weeks of pure enjoyment, good fun, experiencing different cultures, soaking it all in. It was good fun. It was good fun. And then marriage happened. uh, yeah, so that's my relationship with money, and I've always considered money to be an enabler and not
Mm-hmm.
much else.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable, quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is P. Ramanathan, known to us as Ram. He is a Dubai-based entrepreneur and chartered accountant who led a leveraged buyout in 2003 and founded the fund of funds Neeti and hosts the renowned ValueX Middle East conference that brings together 80 of the world's top value investors and allocators each November. Ram, how are you? So nice to see you.
Very, very well. It's hello from hot and sunny Dubai. Humidity is close to 100%, and we are in mid-40s in centigrade terms and probably just below 110 in Fahrenheit terms, for those of you who are in North America.
I was in Dubai for a wedding in July. I've been to Dubai more than once, but years ago it was before COVID, and it was July. I thought I know heat.
Free sauna, Bogumil.
But my wife and I were trying to go on a short walk, and the heat just sneaks up on you. And that's the kind of heat that you don't feel until your body's almost boiling. And we sit down and had a coconut at a little restaurant and felt relieved sitting under a fan in an air-conditioned space. So I know exactly. And it's not even July yet, so I can tell that it's getting there. Ram, I told you that I know you, but I feel like I want to know so much more about you. You and I keep running into each other and spending time together at our mutual friend Guy Spears ValueX in Clusters every year. I got to see you in Omaha with your wife at a Starbucks around the event, the Berkshire event, which was lovely. I'm hoping she enjoyed it. And I was really looking forward to sitting down with you and having a longer chat. I know you're listening to the podcast. You've been sharing with me how much you're enjoying it. And I thought I'd love to have you here and talk more about the work you've done and all the things you're passionate about. I want to start from the early days, if you indulge me. And I like to ask my guests about the early days, childhood, upbringing, and how do you think that time shaped you, your relationship with money, and the career path that you chose?
Well, I left India when I was 22. So up until 22, I was in India. I was born in Chennai, brought up in Calcutta, Patna, and Hyderabad. Very ordinary middle class upbringing. Very loving family. My mother was very resourceful. She even used to sew my sisters' uniforms when they went to school. I know it's very, very old fashioned, but those were the days. And one emphasis my parents always had was on education. So we always got sent to the best schools in town, me and my two younger sisters. Invariably, they turned out to be missionary schools, so I was schooled by Jesuits. And that meant we had good English, reasonable speaking skills, although English is not our native language, and a lot of confidence. So right from a young age, I was a people's person. I used to enjoy going and talking to people and spending time in other people's company. And everyone thought that my father had a lot of money because we were going to good schools and things like that. But the fact is, he was spending a disproportionately large amount of his income on our education. And I think that was primarily because he was the first educated member of his own family. He was from a family of 6, 1 sister and 5 brothers, 3 older than him, 1 younger than him. And he and his younger brother were the first people who went to college in their entire family. And he understood the value of education. He moved out of the village and sought employment in Calcutta. That was where, people used to go to make their dreams come true in those days. And it was the old British headquarters, and soon after independence, a lot of the big companies used to have their headquarters in Calcutta. Since then, it has decayed, but that's a story for another day. And that's where he started his career. And then after a few years, he got married, and then I came along. I was the firstborn. And all this is a roundabout way of saying that he did spend a disproportionate amount of his income on our education. And right from the time when I was in my teens, he used to take me to the bank. I used to run errands for him, taking instructions to the bank to renew fixed deposits and things like that, updating passbooks. In those days, you had to manually update them. And long story short, by the time I was 14 or 15, I knew what my father was worth. And that wasn't very much, thanks to the expensive education he gave us. So I made a mental note that I must start working as early as I possibly can and repay. I wanted to replenish his coffers so that he never had to worry about money in his retirement. And again, my life is full of serendipity, and if you actually analyze it, it's all dull, boring, and unsexy. Everything I do in life seems to be dull, boring, and unsexy. And I've been helped along the way with a lot of serendipity. Anything good that has happened to my life is completely serendipitous. It's nice to say that I planned this and I did that and things like that. But fate had a lot of role to play in my life. So I enrolled as an article clerk at age 17 and a half, I think. And this is the CA education. You need to train under a CA for 3.5 years before they allow you to write your exams and pass.
Right.
And I wasn't sure whether I would pass because it's a very tough exam to pass. So as a hedge, I enrolled in evening classes to do accountancy education. And I had these two parallel tracks running. And luckily, I passed all my exams fairly quickly. And by the time I was 21, I was a fully qualified accountant. And I had a pretty good grades during my in my BCom exams. I was lucky. Serendipity made sure that I found a job with Ernst Young in Dubai. They actually were very kind. They gave me an offer and I didn't even have a passport.
Mm-hmm.
I applied for my passport after I got the job. And then they sent me the visa, and I showed up in Dubai, which was just a strip of sand at that time. And it was the first time I was away from home. And life has been good. Life has been good. I've always considered money to be an enabler. When I was growing up, it enabled my father to give me an education. When I started earning money, it enabled me to replenish my father's coffers so that they had a trouble-free retirement. And once all that was done, it enabled me to, go out and meet people, in the sense I started traveling after working in Ernst Young for about 5 years and moving to Schlumberger. Once I replenished my dad's coffers, it was time to spend money on myself. So it was all various experiences that I was seeking out. I traveled Europe, right from Greece down south to Sweden up north on Eurail, 5 weeks of pure enjoyment, good fun, experiencing different cultures, soaking it all in. It was good fun. It was good fun. And then marriage happened. So that's my relationship with money, and I've always considered money to be an enabler and not much else. Not much else.
You're touching on so many fascinating points and topics. So I grew up with this idea that education is very important, first of all, and it's the last thing that anybody can take away from you. You could have to move, something could happen, life happens. And I've had guests and I have friends that had to move and had to relocate for various reasons. They wanted to or they had to. But education is something that you take with you. And I don't mean just the degrees. I mean everything else that we acquire, the knowledge, the expertise, the wisdom. And Guy Spear would say also the network of people, which is very true, that we build over time. People we can call and ask for help and guidance at different points. And you emphasize...
It's all about people, isn't it? I mean, your education gets you your first job.
Yes.
Afterwards, it's all about how you get along with people, how commercial you are in your outlook, in the sense how entrepreneurial you are. You try to understand businesses that you work for or you start and add value. And that's actually what increases your market value or net worth or whatever you want to call it.
It matters how you treat others. And I think to you and I and many of our mutual friends, it comes as just second nature. That's who we are. But I learned very quickly, accepting my first job, the people I was kind to, they would be kind back. And there's this thinking that you have to cut corners and it's a cutthroat environment and you have to be unpleasant to people. And then I realized maybe quickly you can get something, but in the long run, people will take a phone call from somebody they enjoyed talking to.
So if you actually go back and look at the leadership of Schlumberger, Schlumberger is a pure engineering company, but most of its history in the 80s and possibly early 90s, it was actually run by people with an accounting background. The CEOs were all people with accounting background. Imagine a strong engineering company having
Yes.
people with accounting backgrounds at the helm.
Mm-hmm.
But at the field level, accountants didn't matter. So I was in for a rude shock. I was hired as part of their international team. I was posted in Singapore for a short while, and after orientation, I was thrown at the deep end and sent to Oman. And I think my marriage was 6 months away, and I had lots of time over the weekends. So the first few weeks in the office, it found strange because nobody even bothered whether I existed or not, because I was just an accountant sent from the head office to manage the accounts and finances of the local area. And I decided that I needed to learn how Schlumberger made money. So I got myself a pair of coveralls, got a pickup from the company for the weekend, and then drove to the rig. And I started spending my weekends on the rig, just understanding how money is made. And that made a big difference. And that is how I kind of earned people's respect, because I actually knew a thing or two about drilling, which is what our branch of Schlumberger was doing at that time. And I started getting involved in the bidding and made a very, very active contribution. And before we knew it, we grew the business from 2 rigs to 7 rigs. And that's where I kind of tasted blood of, wanting to be an entrepreneur. I actually made a big difference to the business. From 2 rigs to 7 rigs was an achievement.
I want to explore that part. I feel like there are 2 sides to your career. One is the investing side, one is the entrepreneur. And I think to set the stage, it would be great to go back and talk about the moment when you discovered value investing. Was there a defining moment when you thought of the world in a different way, that you could be an investor, before I ask you about the entrepreneur that I'm very curious about?
You're going to be disappointed, Bogomil. I did not find my way to the church in Omaha until the early 2000s. So that was a good kind of 20 years later.
Uh-huh.
Will you believe it? I started saving when I joined Schlumberger and went to Oman. When I say saving, I mean saving for myself. Right. Till then it was, giving to my dad. My first investment was a fund called Mint Guaranteed Limited. Have you heard of it?
No.
Have you heard of a company called EDF and Man? They are a 200-year-old commodities company.
Oh, okay.
And
yeah,
they are now
known
known as Man Group.
Yes, okay.
And I saw this ad in The Economist. They were advertising a fund called Mint Guaranteed Limited. And what they were basically doing was manage futures. So they will take your money and put 70% of it with JP Morgan or one of the big banks, ask them to put it in T-bills on behalf of the fund. And the fund was a 7-year fund. In those days, it was possible to, the interest rates were high enough to kind of make 30% in 6 or 7 years. So it was a 7-year fund or a 5-year fund, I forget. But interest rates were not as low as they are today. And so that means you get your money back no matter what. And they used to take your 30% and play the futures. And that worked out exceedingly well. I actually went to EDF and Man's offices in London, in Sugar Key, and I spent a morning with them trying to understand what they did. So I learned how to kick tires first, and I didn't learn value investing until the early 2000s. So what happened was the second investment I made, I remember I was with Schlumberger in Damascus, and I saw this ad in the Financial Times. Standard Chartered had advertised a currency fund called Scimitar, and I put $25,000 or something like that in there, and I think it very quickly lost 50%, and I took the money out. So it was a nice kind of baptism to investing. And after that, I think I got too wrapped up in my career. We had a young family, school-going children, and I was, by that time, I had come back to Dubai, and I was the CFO for a trading group. We had offices all over the world, and that meant that I was traveling a lot. So I just forgot about investing. My money was with, I think, a private bank, and they used to offer me products once in a while, and if I liked it, I used to use basic common sense to say yes or no, but no deep dives, nothing. That went on for a while, and then, that meant that I successfully stayed away from the dot-com crash in 2000 and things like that. I was vaguely aware of what was happening, but didn't have too much of in-depth knowledge. And then in 2001, I was headhunted by KPMG to be the regional CFO for an American listed company, which was in the corrosion services business. So another serendipitous moment in my life. I had no idea that I would lead a leverage management buyout team to buy out the Middle East operations of the same business 2 years later. I came across an article on value investing. I forget where. It could be Economist. It could be, it was The Economist. And I started reading a little bit more, and then this opportunity came because they discovered accounting irregularities in our Australian subsidiary in 2001, I should think. 2001, end of 2001. And that was around the time Enron happened, and early 2002, I think it was WorldCom. Banks became very nervous in the US. They asked our American parent to sell overseas assets and pay down debt. I had been in that business for a year, long enough to know that the business had legs. And I got two of my British engineer colleagues interested in the MBO. They were so scared that they wouldn't come to the Middle East. They actually called us to London and said that, look, we have a problem, we need to sell you. You guys did a wonderful job of turning around the Middle East, but you guys are for sale. And here is the agreement. They gave us a retention agreement saying that you will get so much retention bonus if you stay back and help us sell the business, etc., etc. And I opened my big mouth and said, what if I am the buyer? Will I get my retention bonus? And they said yes. So I started getting a little bit of, a germ of an idea as to what the potential could be. I came back and I put together a deck, took it to HSBC Private Equity. They loved the idea, but they said you are an early stage turnaround and our mandate precludes us from investing in early stage turnarounds. Do you mind if we introduce you to a few of our good clients? And they did. And one of them, we had the chemistry. And after a few hand-holding sessions, they decided to back us. And again, it was an inspired choice to do a leverage management buyout because the leverage was being guaranteed by them and none of the liability would devolve on the three guys who were part of the management buyout team. And that was the only time the company ever borrowed. So my value investing education and my entrepreneurial education started at the same time, and they were perfect complements to each other. And I always knew that I didn't have time to manage individual investments, do research and things like that. So right from the start, I started investing time and effort in finding good quality managers around the world. And in one of my reading exercises, I came across Monish. And we started corresponding with each other over email. I met him and I made a small allocation to him in 2005. That is the start of my value investing journey. Very dull, boring, and unsexy. Even the business I do is dull, boring, unsexy. It's a need which will not go away. We are bottom feeders. Anybody who works for us for 6 years is a potential competitor. So very, very counterintuitive business. It doesn't have a strong, wide, and deep moat, but it is a defensible business, and all contracting business take a lot of doing. And if you have the passion to do it right, I think you build your own moat.
What is the business?
So we protect pipelines, tank farms, refineries, offshore structures. We also protect steel and concrete in prestigious buildings like Burj Khalifa, the tallest building in the world, Louvre Museum in Abu Dhabi. We are also involved with the tallest tower in Saudi, which is being built. Once it is commissioned, I think it will be the tallest in the world. Till they build a taller one, I think plans are there to build something which is 2 kilometers tall. It's still on the drawing board, and we are hoping that we'll get involved with that. But whatever we do is a very small part of a large project. So if a refinery is being built and they're going to spend billions on it, we'll probably have $4 or $5 million worth of work. So our clients tend to be in oil and gas or infrastructure. And we generally tend to work for the major EPC contractors like McDermott, Technip, Technicas Reunidas, etc., or directly with the oil companies.
I think you want your competition to think that your business is dull. I think
we have a lot of competition. I genuinely meant it when I said that anyone who works for us for 6 years is a potential competitor. And we do all the right things, Bogumil. We have always done that. We train all our employees. Many small companies don't send their employee for training only because they say they will learn the skills, they will have the credentials, and they'll go out and set out their own stalls. And they just want to avoid that.
So
Whereas we do it the other way around. We spend the money on training, and more often than not, we pay the best in the market. Our working conditions are generally good, and if we lose people, it's invariably to our clients, which is a nice problem to have. We have goodwill ambassadors all over the world.
It's beautifully put. Goodwill ambassadors. Putting on investor hat on for a second, what do you think makes you or allows you to make money, have a profit in a business that seems like it's very competitive? I don't know if the customers are loyal. I imagine there are some contracts that last for a while. But I'm curious how you look at it. What allows you to make money in a business that you think is not that attractive? Which I think I'm ready to disagree with you, but I'm curious how you look at it.
So what gives us the edge is our financial strength, our technical depth, and our geographical reach. So every city we have an office in, we have local competitors. But there are very few competitors who compete with us in multiple locations. And many of the relationships we have are long and old. Lots of people who work in our clients know us, and they know that if CTS is given a job, the chances are that they will do a half-decent job. And even if they have made a mistake in the bid, they will stand by and complete it without compromising on quality. And that, I think, gives us the edge. They are not willing to pay us more than others. What gives us the edge is because we have a network of offices around the world. We have supply chain advantages. We probably get a few percentage points margin improvement because of our buying. And we execute well. We actually read our tender documents. We try not to get into trouble. And these tender documents are, are voluminous. And unless you read them properly, if you say yes to everything, there is a small possibility that something comes back and bites you and your contract becomes unprofitable. We take the trouble, we read it, we execute well, invoice on time, collect our debts. It's a difficult industry, but if someone wants to put his heads down and work hard, It's a very rewarding industry. Most of the costs are semi-variable costs, so it can be controlled in the short run. It's a low capital intensity business, which means you get a lot of bang for your buck. I mean, ROIs are great. I mean, I can just tell you that the business is the main source of my wealth. I would have been a prosperous accountant maybe, but not a wealthy individual had it not been for the business. Have I answered your question?
You have. I think that you pointed out a couple of building blocks that allow you to build equity with your customers. They've been with you for a while, and you go about it in a way that your competition might not be. You're present in many places, you have the expertise. And at the end, you snuck in something that a lot of investors would pay attention to. It doesn't require a lot of capital, and the capital you deploy, you can get really good returns on it. You have people's attention, even if it's a dull and boring business. What I have learned as an investor all my life is that sometimes in very seemingly uninteresting businesses, there's real money to be made. And sometimes it's better because it's not a business that will be on a cover of a magazine and everybody will be dreaming of entering that space. Even if there are competitors, it's not something that Amazon wants to be in or Google wants to be in. It's
too small.
Yes,
too small.
There you go.
It's a very, very niche business. As I said, you might build a $2 billion refinery and just have $3 or $4 million worth of cathodic protection, which is what we do in that project.
But it adds up. It adds up. Ram, I want to ask you about the moment you decided to invest and then choose managers. And I want to go about it in a different way that many people would probably ask you, what's a perfect manager to pick? I want to go the other way. I want to ask you about some counterintuitive lessons that you've learned from a manager you decided not to invest with. And how did that change your perspective?
You're putting me in a spot, aren't you?
You don't have, of course, don't name any names, please. No names, just.
No. I wouldn't. I'll give you 2 examples.
Yes.
I have a checklist approach to deciding on fund managers, and when I was influenced by Atul Gawande's book, The Checklist Manifesto. It resonated with me, and I think there was a period which was, I think it was the late 2000s when I first met Guy. I think he may have given me the Checklist Manifesto, and we did talk about checklists at that time. It is. And I started using it. So let me just step back as to how I got into investing in funds. I didn't have time to pick securities. This business was giving me steady dividends. I had to deploy the wealth. I started traveling the world. Whenever I used to go on a business trip, I used to meet a fund manager. I used to find the time to meet a fund manager, learn from him, try and find out, what his approach is, etc., etc., etc. So it was more by immersing myself into it, and then I started attending value conferences around the world. I've attended conferences in Trani, I have attended conferences in Spain, Guy was very kind. He invited me to, I think I've been attending ValueX since its 2nd edition, and I don't think I have missed a year. So you just learn by immersing yourself. And so my wealth used to be distributed in 3 private banks. They had a very simple mandate. I would be a self-directed investor. I'll go do reading, sussing out, etc., and decide on a fund manager and tell them, do all the paperwork, subscribe to so many $100,000 worth of funds and put it on my account, and your job is to give me a valuation at the end of every month. Plain and simple, self-directed investing. Over the years, I developed a checklist approach so that, I could refine my selection process, because I was getting, the top of the funnel was wide enough for me to have lots of ideas to look at. So the checklist approach made sense. And then most of the initial kind of items on the checklist were all quantitative items, what was the past returns, how did the fund perform during 2008, did it survive or did it have a major shock? If it didn't have a major shock, what did they do differently, etc., etc. Slowly, as I became immersed in this value investing group, qualitative factors started coming in. How much pride is there? How much ego is there? Etc., etc. I met this young manager in America. I wouldn't even name the city so that people shouldn't start getting ideas. And he had a stellar track record. The other thing I don't do is I don't invest sight unseen. I must meet the manager, and preferably, and I'll invariably start with a small allocation and then build it up. And here I was sitting with this guy. I was talking to him about his record, and once you start talking to him, he kind of opens up, etc., etc. I casually asked him, what do you think, justifies the fees that you charge? If you have true alignment of interest, shouldn't your fee structure be this way or whatever? And he gave me a very sharp retort.
Right.
And he said, he basically was saying that he was a super jock. And I said, maybe I shouldn't stand judgment on the guy. I went away. He was on my radar, but I didn't pull the trigger. And 6 months later, I was again in America, and I said I must give him another chance. And I went and met him, and he was as proud, arrogant, and egoistic as he was the first time. And I decided against investing in him. And believe it or not, a few years later, he got into trouble by saying something wrong on social media about someone who ran a big endowment, which is so wrong in many ways, but he did get into trouble. So I was glad that I, stayed away. The other example I would like you to have is, there are certain specialized fields, biotech, for instance. I have a decent sized allocation to biotech in my fund, only because over the years I've had good exposure to good managers who know what they are doing. All three of them are hugely qualified and know the industry. Again, great talented manager. He was a generalist. He was running a go anywhere fund, and I noticed that he had a few biotech positions which had done exceedingly well. So I started asking him about his background as to what gave him the edge to buy these stocks, and he couldn't give me a straight answer. It wasn't like the balance sheet was stellar or the returns were great. The company returns were great. It wasn't, say, an Eli Lilly with a weight loss drug in its portfolio which had a great future. It was companies which had decent science, but a science which he didn't understand because his background was totally different. So he was obviously riding on someone else's coattails. And that kind of put me on alert, saying, would his other positions also be inspirations from someone else as opposed to hard research? So I stayed away from him. I was receiving his fact sheets and things like that. But 2 or 3 months later, those biotech positions blew out, and he had just as he had great returns the previous months, he started having extremely bad returns when the stock started nosediving. So these are two instances where, if you look careful enough, and if you have your eyes and ears open, you can't stay out of trouble.
No, I like both examples for different reasons, and I think they're very eye-opening. I manage money for families, long-term patient capital. I've been doing it for 20 years, and I manage stock portfolios for them. There's nobody between me and the idea and me and the client, which I like. And I was thinking the other day, if somebody was to evaluate the work of an investment advisor, fund manager, professional, it's very tricky because you're looking back, but you want to look forward a lot. You want to see what this person is doing, what's their philosophy, approach, how consistent they are in it, and how they will continue to grow, change, evolve as the markets evolve. So even Buffett had a lot of success in the 50s, 60s, 70s in very different stocks than he's investing in now, right? So when we appreciate what he does, and it's no endorsement here, I think everybody has to do their own research. But you see successful managers over decades, how there are some principles that are, well, if we're picking on Buffett, that have not changed, but the execution has changed and the context has changed, right? It's very tricky, especially when it's a more concentrated approach. And Buffett's approach, he has a lot of businesses, we forget that, but it's a fairly concentrated portfolio of large bets that he has made. And they're very different than the ones that I read about in Brett Gardner's book, where he studied the early investments that Buffett made more than half a century ago. It's the same Buffett, but a different execution. I think it gets tricky, but the point that you're making, a lot of ego, a lot of pride. I mentioned how I want to be the least wrong any investment decision or in life in general.
Absolutely right.
And I feel like anybody that comes to any pursuit in life that wants to be absolutely right, it's a very dangerous place to be because you leave no room for error. And I mean, overconfidence in many pursuits can be either costly or actually painful, even physically painful in some pursuits.
You may just get too attached to your position and not get rid of it, even if you have evidence which points to your mistake. You're too
Very
egoistic.
so.
You're too proud.
Any investment I consider, I start with talking myself out of it.
Good way to approach investments.
Good way to approach investments. How can I be wrong about it? And people say, well, you're pessimistic. No, I'm just cautious because if I think of everything that can go wrong, the upside will take care of itself. I think the narrative is often flipped on its head. Like even the way a lot of investment discussions happens is, so what's the price target? And I'm thinking, well, that's great. Give me a number, but how bad can it get, right? And if you eliminate some things, you talked about the checklist. I have many checklists to eliminate and include certain things. But if you eliminate too much leverage, if you eliminate questionable management, and if you eliminate an industry that's in a secular decline, which I think it's a dangerous territory for value investors that are looking for cheap things, there's a lot that you take out of the equation. I learned from just analyzing stocks that I considered over the last 20 years, and the three buckets cover probably 90% of trouble I can think of, and usually it's a combination of the three in some way. But if you get rid of that, then you can be optimistic about new products, new markets they enter, anything else, pricing power they have, you name it. But let's cover the foundation here before we build a tower. I want to ask you about a belief about investing or business or both that you hold that most people would disagree with, and why do you remain convinced that you're right?
Good question. Very, very good question. In business, especially with this Wall Street culture of quarterly reporting and things like that, it drives counterproductive behavior.
Yes.
Very, very short term in their thinking. And people actually glorify short term results. That, in my opinion, is wrong. And I personally believe that we shouldn't fixate on short term results, even in our business. It's a very, very cyclical business. And I think it was in your podcast with Ardal where you said Tim Cook doesn't know what his next quarter results are going to be. And here we are, analysts analyzing it to bits and saying that this is the target and this is this and this is that. And I know it as a businessman that it's very, very difficult. We don't even control our revenues, Bogomil. Our revenues are controlled by my clients.
Yes.
A client may have even inspected the goods, but unless he gives me a shipment release, I can't invoice it and take it into my revenue.
Yes.
And I'm a small business, and a large order can swing monthly results, a lot.
Yes.
A lot. And therefore, to fixate on short term is wrong. And this is what I would like to tell everybody, both in business and in investing. Just don't worry about short term results. Don't have leverage. Don't have the banker knocking on your door. You'll be just fine as long as you've done your homework.
I'm always thinking about incentives. So I know that there are people that do things because they love what they do. And I think that's what we're really looking for. It comes up in many conversations in this podcast, as you might have noticed, how we're looking for a CEO that will just loves the business. And I can tell that you love your business, the way you talk about it and the way you think about it. So yes, you get paid to do it, but that's not why you show up every day. But then there are incentives that really affect us. And I think a lot of the incentives in the investment profession, broadly defined, are focused on very short-term results. If you tell sell-side analysts that we're going to reward you if you guess what the earnings are per share next quarter, and we're going to have rankings of the analysts that get very close to that target, what do you expect to happen? That's what they will play. If you pull up, and I haven't read a sell-side report in a long time, I have a lot of respect for a lot of people in the profession, and I think they're very smart. I think their talents could be used in some other ways, and some people eventually shift to other fields, and I think they flourish even more so. Anyways, long story short, they don't even look at the balance sheet. Like if you read an average report that I used to read years ago, and somebody would leave it on my desk, and I always thought, how can you analyze a business without pulling up a balance sheet? You're an accountant that used leverage to buy a business, right? You know how a balance sheet works, and you know how it can work in your favor, and you can get yourself in trouble using the balance sheet too.
By the way, that was the first and the last time we have had leverage. We have been
there you go.
Completely no net debt on the balance sheet, debt-free, cash-rich, after year 3 of our MBO.
You knew exactly why, that you have to be outside of that, because that makes the business vulnerable. I would put it this way, when it's a healthy business that has customers, paying customers, and something that the customer wants, this business will not go out of business until the last customer leaves, unless they have leverage. You could have a business that is doing very well, but if you put too much leverage on it, there might be a period in any industry where you have 6 months, a year or 2, where things are just not going your way and you don't have control over everything. Can you make it through that period without losing your business? It's
two things. There is a common thread running between. There is a common thread of 2 factors in every bankruptcy in the contracting industry. It's leverage, aggressive revenue recognition.
Yes.
The way the accounting standards are, you can get away with murder if you want to please Wall Street, just by playing around with revenue recognition.
Mm-hmm.
So there is a clear written rule in our company. Anyone who, plays around with revenue recognition gets fired. There is no pressure on anyone to meet quarterly numbers. But if you play around with revenue recognition just to prove that you are a hero,
yes,
it's a strictly no-no.
Mm-hmm.
Strictly no-no. So we just don't do any Mickey Mouse. It's all muscle, no fat balance sheet that we have. No leverage, I sleep easy. Come COVID, we were one of the few small contractors who paid our vendors on time, paid our employees 100% of their salaries on time during COVID. We had major oil companies calling us and saying we need a discount, as if COVID was affecting them so much.
Right.
Just knee-jerk reaction.
Huh?
These are major oil companies calling you and asking you for discounts only because they can. The governments around the Middle East announced that you can trim salaries if you want as a temporary measure just to stay afloat, because there is no bailout programs and things like that here. And we chose the other path. We said we will pay 100%. And that was only possible because I have a lot of cash on the balance sheet. I'm the worst capital allocator in the world.
You're too harsh on yourself. I think what you're trying to say, you want to survive, both in business and in investing. And it's something that's not talked about enough. But to survive, you can't be operating at the absolute maximum of leverage and whatever it is, the metric is. You can't. You have to leave some margin of safety, some slack in the system, because even running your own budget in the house, right? You hopefully don't spend the last dollar 5 days before the next paycheck comes. Hopefully you don't run your household like that, right? I mean, it's intuitive, isn't it?
True.
But then when we think of business or investment thing, we think that we have to deploy the last dollar. There can't be anything sitting in cash. I know people that are so focused on not having any uninvested cash. And I'm thinking, why not? Don't you run your household with a little bit of spare cash left in the drawer just in case the car breaks down, the window needs replacing, there's a leak in the roof? Don't you have a little bit? I know it's a big ask, but it's intuitive when it comes to a household.
In the contracting industry, there are just too many uncertainties, Bogomil. Too many uncertainties. We've just signed the biggest contract in our history. It's a 5-year contract with one of the biggest oil companies in the region. And there is a lot of startup costs. 99% of the companies in our place would have borrowed for the startup before the cash flow starts. You need to mobilize tons of people, equipment, etc., etc., etc. We did it all without borrowing a dime. So right now my cash position is sensible. So if someone looks at my balance sheet today, they'll say Ram is a good capital allocator. But come end of the year,
cash will be back.
I'll have loads of cash on my balance sheet and they'll say this guy is a poor capital allocator.
So Ram, I have to ask, why are you this way? And I'm praising you at the same time, but why are you this way? Why is that important to you?
It is important because otherwise we'll be at the mercy of banks. And you know how bankers are.
Yes.
They want to give you an umbrella when it is nice, bright and shiny and want to take it away when it starts raining.
Yes.
So why go there? Why have the aggravation?
But what taught you that? Was there a moment, was there an experience that taught you that? A lot of people get it intuitively, but for some, I know people that run businesses that get in trouble because they never really grasp the extent of the risk that they're taking.
I don't know. I think it's just being sensible. And as I said, after I joined this value investing community, a lot of my thought processes are also similar in business as just as value investors think. I mean, we don't like leverage as value investors. I don't like leverage in my business either. So conservative, and plus my upbringing, I guess, a very conservative upbringing. So
it stays with us. My grandma is against leverage. She's 90 and she took out a loan a long time ago to pay off the house she was building with grandpa. And I don't know how many times she told me that she was watching the loan. She would pay it off as fast as possible and never wanted to have another loan in her life. And it just stayed with me. Loans, you need them sometimes. They, of course, they play a role in personal life and business life. But pay attention and watch them, because there will be a moment like the one you described where it can
No,
get you
don't
in.
get me wrong. We do borrow in countries like UK and India,
Mhm.
where you have a tax shelter. I mean, the interest cost is partly borne by the government because you have taxable income there. But on a net debt basis, we don't. We carry a lot of cash, and
You're very, very disciplined about it. As far as I understand, on the investment side, you have an unconstrained global mandate. So I'm very curious. You're looking at the whole planet. What are the most overlooked regions or investment opportunities? And I don't want you to be, specific with, stocks or names of managers, just big picture. Some parts of the world are growing, some of them are not, some are aging, some are younger. And I'm just curious how you look at it. Where do you see an opportunity with such an unconstrained mandate?
you hit the nail on the head, Bogumil, when you said that as if you protect the downside, the upside will take care of itself. And the way I do it in the fund is having my fund in four buckets. You can call it three buckets because all sensible investing is value investing, but two of the buckets are value and growth, and the third bucket is ballast. Ballast is funds which are generally long short, who have a simple aim of producing 9-10% returns every year, no spikes at all. And I have a 28-30% allocation to biotech.
Very specific.
Very specific. And the idea is to have as low correlation between these buckets as possible. And the idea is to make steady eddy, high single digit, very low double digit returns with muted downside. Very, very simple philosophy. This allows me to actually look for areas which are interesting. So, for instance, 3 years ago, just when Buffett had announced that they had this investment in China and he had very cleverly structured it, etc., etc., I started getting interested in Korea. Korea was probably the cheapest sensible market around, with world champion companies being listed there, etc., etc., etc. So I personally feel that Korea is a market that people should look at. Another thing I want to tell you is everything I touch turns into lead before it turns into gold. So Korea went nowhere for the last 2 or 3 years because of the quality of the fund managers I allocate to. They did reasonably well. I expect them to do exceedingly well this year. So you need to be patient, but that is one area that investors can look at. The other area is biotech, but it's not for the faint-hearted. It's to give you an example, Bogomil, the index, the XBI, was at 160 at its peak in, what are we now? We are 25. At its peak in 22. Then it corrected to 60. And then in the last 18 months or so, it went up to 100, and it came back to 67 or something in February this year, March this year, and it's back at 80. All that I'm trying to say, it's not for the faint-hearted.
Bumpy road.
It's a bumpy road, but someone with a keen sense of the science and a sharp eye for the numbers can make a lot of money. So the fund managers I allocate to are extremely, what shall I say, they have 20 years of track record in this industry and extremely knowledgeable, etc., etc., etc. And today, you can buy the entire SMID biotech space for just 1 year's earnings of the pharma majors. And they are horrible at research, and therefore they have to buy companies to avoid the patent cliff situation. So that is how attractive this this segment is. So these are two segments I would offer to your audience to look at.
And it goes without saying, anything we talk about here, it's no endorsement, no advice. Do your own research.
Absolutely.
And
do your own research.
What works for Ram might not work for you, whoever's listening.
True.
I do want to bring up 3 things that I wrote down as I'm listening to you. You know, I have this idea that a lot of people, and I know from talking to so many people, buy the right thing at the right time, even for the right reasons, but they can't hold it. And I like that reference you said, that when you touch something, it turns into lead at first. I had so many investments in my life that the first year, they really tested my patience. They either went nowhere or slowly dwindled. And I have a choice, question the work I've done or wait a bit longer. And, I jokingly say that I don't think I'm smarter than anybody else or faster than anybody else, but I can definitely be more patient than most. I have control over it. And waiting those periods out makes a difference. And I'll bring up Chris Mayer, who was on the show, who wrote the 100 Bagger book. And he pointed out something that really reminded me of something significant, is that even those successful companies that we think of today, they had periods of 3, 5, and more years when the stocks went nowhere. And it's really, really hard. And he mentioned to me, which I agree with, that those periods are harder than a drawdown, because so many stocks actually recover from a drawdown, especially excessive drawdown. Within months, they start to come back, if not all of them, but the ones that actually have some substance to them. So the drawdown, it's painful in the moment, it ruins your mood for the afternoon, but but waiting 3 years for a stock that has to come around, it really tests, right?
Not a fund.
And one last thing that you brought up, I would call it what's the journey like? When people tell me, the returns and so on, I'm asking about the journey. How did we get there? And a manager that has, down 30%, up 30%, down, up and down, up and down. A lot of people cannot participate in a journey like this. My clients cannot. I'll be frank about it. It's families that have had wealth over many generations. In many cases, it's all the money or the only money they have. It's very important to them. It's been around for a while and they can't make it back. So it's the money they don't immediately need, but it's the money they cannot afford to lose, which is very important. And day to day, as much as they would like to grow it and compound it, and we aspire to do that, the journey itself, taking them through a massive drop and a massive recovery, it's not something they want to experience. Although mathematically, academically speaking, I understand that maybe the other way is superior in some way, in terms of the rate of return. But very few people would stay with you on the bus if you drive like that.
Very, very true. Not just that. You have a mandate for generational wealth creation.
Yes.
And as long as you protect the downside, the upside will take care of itself on a long enough time frame. A percentage lower return on the upside is not going to kill you.
Exactly.
You'll still compound fine. People fail to realize that. And if you can, steward them through Liberation Day, if you steward them through 08, if you steward them through 2020, you'll do just fine.
I took some calls in April of this year and 2025, the Liberation Day, or I as like to call it the President's Day, which is the big sale in the US, but earlier in the year. But I feel like we had the President's Day sale in April. And March 2020, very vivid memories and before. And clients would call me and say, I just wanted to hear your voice. I know what you're doing. You're probably buying. I just wanted to say hello. And I thought, it's so empowering. You build trust with them over many years, but they know what you're doing at those times. And you're not taking them through the toughest roller coaster ride available. And you're respecting the fact that, yes, the returns matter, but how do we get there? matters too psychologically. And, an academic will write a paper about an optimal portfolio or whatever it is, but an actual human might not have a stomach
True.
to be a part of it. I want to ask you about something that I value and our friend Guy Spear values, which is sharing knowledge, building communities. You launched ValueX Middle East. You have people coming. I'd love to attend at some point. But tell me about that experience, bringing people together, sharing knowledge, what it's been like for you. Tell me about the inspiration.
Bogomil, you are most welcome to attend whenever you want.
Thank you.
I really would love to have you here.
Thank you.
I noticed this morning that you're not on the ValueX Middle East mailing list, and I added you very quickly there.
Thank you.
So you will start receiving emails in your inbox.
Thank you.
I have no one except Guy to thank for ValueX Middle East. I got so much value out of ValueX and clusters, and I kept telling him that, Guy, we should do one in the Middle East, and I would like to do it if you will support me. And he's, as you know him as well as I do, he is very, very supportive. And I remember this was 4 years ago in the middle of COVID, and I knew that COVID was going to kind of wane. And I wrote to him on a summer morning, I think it was March or April morning, saying, Guy, we met a couple of months ago in Zurich, and you were very supportive about ValueX Middle East. How about kicking it off this year? And so this was the weekend. My wife and I were at brunch, and Guy calls me and he says, I'm in London taking a walk. I saw your email come through, and instead of replying to your email, I thought I could talk to you. And then he gave me and he gave me 3 dates. He gave me 2 dates in November. And since it was so far away, without even thinking, I said, fine, we'll do it on that day. And long story short, COVID worsened. There was a lot of uncertainty all around the world.
Yes.
China, Hong Kong, Malaysia, Singapore were the 4 areas which were the strictest. Korea was fine, so I had a few Korean friends show up. But many of my friends from other parts of the world were finding it difficult to show up. But we had a motley crowd of about 30 people at the first ValueX. And that gave me the courage that if in a COVID year we can pull this off, we can, it will grow from strength to strength. So my sense of timing was all wrong, but in the end it worked out all right, like a lot of things in my life. And it's just an attempt to give back to the community.
Yes.
I firmly believe that all of us are better than some of us. If we are all together, there is a lot to share. There is a lot to learn from each other. We all as value investors agree that we can't see the future. Any forecast is an exercise in, what did Buffett call it? Is an exercise in voodoo science, maybe. But, being with like-minded people, we can see the present clearly. We may not be able to see the future, but we'll see the present better and clearly. We can't know everything, but we may know people who know more than us in certain specific areas. And that's a lovely platform to, share those ideas. And we have a very active WhatsApp group. So there is a lot happening on the WhatsApp group all around the year, in fact.
I wrote a piece a few weeks ago after Omaha and earlier clusters this year. Eyes in 1,000 places. I travel and I go places, and I was in Asia this year and around the US and in Europe, but I can't be everywhere. And I definitely cannot be actually present everywhere, but I have friends in many places, and I want to know a little bit more what's going on or what's their local perspective on things. I'm a phone call away from so many wonderful souls out there. So this is my idea of, having 1,000 eyes in 1,000 places, that I can be present, and you and Guy and ValueX community and others, they play that role, and we do in each other's lives, that we can be those eyes where I can't be physically present, but there's Ram watching, and I can call Ram about it, and he'll tell me exactly what's going on.
True, and I tell Malika all the time. I mean, there is hardly a city in the world where there is not a value Xer who we can, who
Isn't
we
it
have
wonderful?
met. Or it is.
I have one last big question for you, but before I ask, then you might know what it is. I do want to sneak in a question about being a Toastmaster. You and I talked about it. You have experience as a Toastmaster. You hosted some events. For the benefit of the audience, what's that all about? It played a big role in my life. I feel like it allowed me to improve the way I communicate in general. But just for the benefit of the audience, I know that you have some fond memories of being a part of that universe.
Yes, I mean, in college, I was asked to make a speech, and it was kind of sprung on me, and it was an Independence Day speech. And I started very well. I said, I think I said, eternal vigilance is the price of freedom. And then I saw the sea of faces in front of me, and I forgot the rest of the speech. And then I think I barely managed to deliver part of what I had written, and I hoped that the stage would open and swallow me and put me out of my misery. At that time, I resolved, all of us are very, very comfortable talking to people we know or on topics that we are familiar with.
Yes.
But the moment you're talking to a strange audience or a new topic, we sometimes tend to clam up.
Yes.
Toastmaster helps you overcome that. In fact, it's a matter of pride and joy that Guy, who has given us so much, I was the one who introduced him to the idea of Toastmasters.
You did. How wonderful.
When we met for the first time in, I think it was 2007 or was it 2006 in New York. And again, Guy is one of those guys who is quite happy to be vulnerable in public.
Yes.
And that is a very, very strong plus point in his character.
Mm-hmm.
And when he mentioned this, I said, you ought to try Toastmasters. And he said, what is Toastmasters? And I gave him a spiel. Basically, it helps you be comfortable in situations where you're addressing a strange audience, or you're talking about a topic that you're not that familiar with. The biggest plus of Toastmasters, in my opinion, is you learn the art of giving constructive feedback. What we say in Toastmasters is evaluation or giving feedback should be like gentle rain which nourishes the roots, and not like a storm which washes away the soil and the plant with it. Your number one challenge as an evaluator is to make sure that the speaker wants to come back and do another speech.
Very important.
Yeah. So, and Bogumil, I'm not lying when I say that I have not known a Toastmaster to fail in life.
Wow.
They all ended up being successes. It was so much fun reaching out and touching so many lives when Malika and I founded Toastmasters in Dubai, 30 years ago. And there are now 200 plus chapters. Incredible. Reaching out and touching so many lives every day, every week, every year. I know of a Toastmaster who migrated to Canada, and even in those days there were no, emails and things like that. But when the employer saw that he was a Toastmaster, he had a job even before he landed there.
Wow.
Because he knew he would be all right. He will communicate well. He'll be confident. So let's give him a job.
It's one thing to have ideas. It's a different thing to be able to share them. And if you don't share them, you don't give them a full chance to flourish out there. Buffett apparently on the wall in his office has the certificate that he finished the Dale Carnegie's public speaking course, if I'm correct about that. And he had this saying, which I'm paraphrasing here, that it's not that he wanted his knees to stop shaking when he speaks, but he wanted to be able to speak when his knees are shaking. And there will be moments when we're shaking, but we still have to get up and talk, whether it's a business event. Go ahead.
True. There is a saying in Toastmasters for this. We can't get rid of your butterflies, but we can help you make them fly in formation.
I think that was my big realization, that feeling of anxiety will never go away, but I can work around it and I can still do what I'm trying to do and deploy that energy in a more positive way rather than, freezing and getting stuck. And the two formats of Toastmasters for people that want to explore, the prepared speeches and the impromptu table topics, I think it's a wonderful way of approaching two challenges. One is to deliver a speech that you know what's coming and you know what you're going to talk about. And the other one, somebody in the room says, Ram, can you talk about biotech? And you haven't prepared anything. And here you go. You're going to talk about, whatever it is at this point that you know about biotech. And there you go. Anyways, I think it's a wonderful experience. And as you mentioned, there are many chapters. It's a nonprofit. You can join, you can participate. I used to go to one in New York that I stayed friends with people for years, many years after that. And it was in a beautiful building and we really had a great time. And I met people from so many walks of life, real New Yorkers that I wouldn't meet any other way because we were all...
Those friendships are enduring, isn't it?
Exactly. And just people that I would see on the street, but we would never really meet in the room because we're in different fields doing different things. And here we were sitting, all professions you can think of and all ethnicities and backgrounds in one room, all with one challenge. How do I get up and give a talk? Not just get up and say something, but say it in a way that makes a difference. Ram, I have one last big question and it's coming. I want to ask you about your definition of success.
Success. I want to make a positive difference in every endeavor I undertake. In the sense, if I start Corrosion Technology Services, I want to make sure that the lives I touch have a good feeling at the end of it all. If I start Toastmasters, ValueX, Neeti Fund, whatever, I want to make a positive difference. In relationships, I'll be very, very happy if Malika and I get the feeling that our children who are given decent education and a value system, all that we can do is hope and pray like hell that they turn out to be good, honest, upstanding individuals. If we have achieved that, I think we have lived a successful life. So success in my book is making a positive difference in everything we try and do.
I love the sound of it. And I know that you do. You touch so many lives in so many ways. You touched mine. And I appreciate having you in my life and meeting your wife. Maha, it was fun. And I'm looking forward to attending ValueX Middle East at some point, if not this year, then in the future. And sure. I'm very grateful for this hour that we had together. I really learned a lot. And I told you that I know Ram, and now I can say I know a lot more about Ram than I did an hour ago.
Thank you very much, Bogumil. You don't realize it, but you're doing a great service. I mean, the range of people who come on your podcasts is just incredible. I mean, they are not necessarily finance professionals. They are from all walks of life. And that's what makes it interesting.
And what touches my heart is that there's always somebody recommending somebody for me to talk to. And I've been so fortunate that everyone out of the 150 plus people I really enjoyed talking to, I learned something. And they brought all kinds of perspectives on life, money, investing, and everything else in between. And I love that. And as you said, they're not all investors, but they add something that makes my life, my pursuit, and the pursuits of my audience, I hope, and my guests more complete, more enriched, and fuller. So it brings me so much joy, and I'm having a blast with it. So I'm looking forward to many more.
Excellent.
Thank you so much, Ram. I really appreciate it.
Not at all, and good luck in your future episodes, and I'm sure it'll be a mainstay with me in my gym.
And I know you're working out longer, which means you get to listen to more than one episode, which is a bonus.
True.
Thank you so much.
Thank you.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.